Okay, Assalamualaikum and good evening. Right, so
Salam, Doctor.
yeah, for today, let's continue with still topic number 5, yeah, under the topic of company analysis and valuation. So we already discussed until last week at the class, but I hope you watched the video anyway. So for today, we're going to continue with the fourth model under the present value of dividends, or the DDM, dividend discount model. Okay, as a recap, under this DDM, we have 4 different models. Number 1 is constant growth. Sorry, not constant growth, constant dividend. And then we have inconstant dividend. The third one, we have constant growth. And for today, we're going to continue with the fourth one, which is inconstant or non-constant growth. Okay, non-constant growth model. So to identify this type of model, okay, you can check on the growth rates. Okay, so the difference between the fourth model, which is the non-constant growth, and the constant growth, whereby the constant growth model only have one growth rate. Okay, meaning the growth rate will remain constant throughout the time. Okay, but for the non-constant, okay, for example like this one, corporation just paid dividend of RM3. Okay, so we know this is dividend, and based on the indication here, it is a just paid. Yeah, just paid dividend. It's just a recently paid dividend, and therefore this would be our dividend 0. Okay, our current dividend. And assume that the next 3 years, okay, the dividends will grow with a different rates. Okay, 5% next year, 15% in the second year, and 25% in the third year. So this is the indication of the non-constant growth model, because we have a multiple growth rates. Okay, so when you see more than one growth rates, it's automatically will be for the fourth model, okay, the non-constant growth model. And furthermore, this company will expect that the growth rate to level off to a constant growth rate of a 10% for the following year. So technically, we have 4 different growth rates: 5 to 15 to 25, and lastly to 10% thereafter. Okay, so this 10% will remain constant, okay, indefinitely. And the question also gives us the required rate of return, which is 15%. So this is our K, required rate of return. And the question asks us to find the intrinsic value, okay, using the multi-stage. Okay, this is also similar to the non-constant. Okay, the non-constant growth model. So when we talk about non-constant growth model, how we want to find the intrinsic value slightly longer. Okay, the steps slightly longer as compared to the first 3 models. Okay, the easiest or the fastest one to calculate, it should be the constant growth model, the third one, whereby the formula is very straightforward. We have this formula before: BI equals to B1 K minus G. Okay, so this is based on the constant growth model. Okay, but for the non-constant growth model, like this one, example number 4, it will be slightly longer. So let me share with you the steps. Okay. So I'm going to use this one to illustrate together with this with the example. So first step, when we talk about non-constant growth, non-constant growth model. So step 1. Okay, step 1. Find dividend. Okay. Until the final year of G change. Okay, so the final year. So what does it mean? Okay, let me go back to the question. Okay, so again, based on this question, the companies has 4 different growth rates. Okay, first year 5%, second year 15%, third year 25%, and when they said 10% next year, so it indicates that the 10% will be the 4th year onwards. So therefore, based on step number 1, okay, based on this step number 1, try to fit in everything in one slide. Okay, find the dividends until the final year of the G change. So therefore, based on this example, the final G change in year number 4. Okay, this 10% happened in year number 4. Therefore, we need to find dividends until year number 4. Okay, so as a starting point, look for the dividends given in the question. Right, so in this case, the dividend is 3 ringgit. And you need to identify this 3 ringgit. Is it the current dividend, which is D0, or the next dividend, which is D1? So that's your starting point. So the question might give you D0 or D1. So to differentiate between the two, okay, so for D0, like this one, they use the word just paid, recently paid, or anything related to the dividends is already being paid to the shareholders. Okay, so if that's the case, it's D0. Okay, but if the sentence they use or the words they use, they might use the word like Opel Corporation will pay, will. Okay, next year's dividend will be, all right, or usually they use the next or or the following dividends, contohnya. So all of the words related to something that haven't been paid yet, it indicates D1. Okay, so you need to be careful about that one. Okay, either they use the word just paid or next dividend, next year's dividend, for example. So if they use the word next year's dividend, this 3 ringgit will be D1. Okay, and you will start with D1 lah in your step number 1. But for this case, it's D0. So we will start with D0. D0 is 3 ringgit. Okay, D0 is 3 ringgit. And we need to find D until D4, D year number 4. Okay, because that will be our final year G change. So next we move on to D1. To find D1, what you need to do is to increase this 3 ringgit according to the respective rates. Okay, the respective growth rates. So for example, this one, the first year, okay, year number 1, the growth rate is 5%. Okay, so we're going to increase this 3 ringgit with 5%. Okay, 3 ringgit with 5%. So 3 ringgit with 5%. So we have here 3 ringgit 15 cents. Okay, 3 ringgit and 15 cents. And this 3 ringgit 15 cents will be carried forward to the second year. Okay, so for the second years of dividend, D2 is 3 ringgit 15 here. And we're going to increase this by second year's rate, which is 15%. Okay, based on this question, second year's growth rate is 15%. So we're going to grow or to increase this by 15%. So 1.15. Okay, the 0.15 is the increments, and 1 is the original value. So that's why we use 1.15. So 3.15 multiplied by 1.15 increments. So we have here 3.62. Okay, so for second year, the dividend would be 3 ringgit 62. So you can see current is 3 ringgit. The following years increase to 3 ringgit 15 cents, and then second year increase to 3 ringgit 62 cents. Next, 43 is 3 ringgit and 62 cents will increase at 25%. Okay, for the third year, it will increase by 25%. So we're going to increase by 25% here. Okay, increase by 25%. So we have here 4 ringgit and 53 cents. Okay, so this is the third year's dividend, 4 ringgit and 53 cents. And finally, we're going to increase this 4 ringgit and 53 cents for the fourth year by 10%. So the final G is 10%. Okay, 10%. So we're going to increase by 10%. So we have here 4 ringgit and 98 cents. Okay, 4 ringgit and 98 cents. So this is our first step. So find dividends. So we have multiple of dividends here. And we're going to find until the final of the G change. Okay, so it's depend on the question. Okay, it can be 4, it can be 5, 6, 7, whatever. Read the questions and identify the last or the final year of the G change. Okay, so that's our first step. Okay, so what we need to do is to find the dividends. Now, moving on to our second step or step number 2. Right, so for step number 2, since we already find dividends, if you remember the concept of dividend discount model, let me go back to this concept. When we do dividend discount model, we are actually discounting, okay, or present valuing the cash dividends and also the selling price. Okay, that's our concept of discounting of dividend and also selling price based on DDM model, right? So for example, for constant and inconstant dividends, the dividends and also the selling price usually given in the question. Okay, but for non-constant growth model, we need to find ourselves, okay, the dividends, which we already done in step number 1. So now we need to find the selling price. Okay, so therefore for step number 2, we need to find the selling price based on find the selling price based on 1 year before the final G change. Okay, so find the selling price based on 1 year. This is 1 year before the final G change. So based on step number 1 earlier, based on example 4, our final year happened in year number 4. So based on step number 2, we're going to find the price based on a year before final G change, meaning we need to find the price for year number 3. Okay, based on this question, you're going to find the selling price based on year number 3. Okay, so let me share with you the formula to be used for step number 2. Okay, because I'm going to give you the general formula first, which is based on N. V is the value, N is the year that we want to find. And the formula would be D, dividend, N plus 1. Okay, N plus 1 divided with K minus G. Okay, so this is very familiar formula. In fact, our constant growth model earlier, this one still here, is based on this model, okay, or based on this generic formula. Okay, why? Because if you look at this one, this is constant growth model, okay, whereby VI ataupun the intrinsic value technically means the price or the stocks today or the value of the stock today. So VI here is actually equals to 0, V0. Okay, so VI is intrinsic value. It's actually equals, or you can use the terms V0 as well, which indicates the value of the stocks today. Okay, 0 refers to the, kalau kita letak V1, it means value of the stocks next year, year number 1. So on V2, V3, V4, it depends on the number of year. Okay, so whatever number of N here, for the dividend, we need to add with 1, plus 1. Okay, so if you go back to this constant growth model, if this is V0, okay, which is the current price or the current value, So for the dividend, we need to add 0 plus 1, okay, based on n plus 1. So n is 0, so 0 plus 1 is 1. So that's why our formula for intrinsic value is D1. Okay, V0 equals to D1 divided by K minus G. Okay, but for this question, the G change, or the 1 year before the final G change, would be V3, which is the price or the selling price in year number 3. So therefore, we need to find the value of the stock for year 3. Okay, why again, I repeat, why we need to find the value for the year number 3, because you want to find the price 1 year before the final G change, which is in year number 4. So 1 year before year 4 is year 3. So V3. So if it's V3, imagine this is 3, n is 3. So n plus 1 means 3 plus 1, which is 4. So therefore, to find value of price in year 3, we have to use dividend for year 4. Okay, dividend of year 4 and divide with K minus G. Right, so we substitute the information that we have here. So D4, if you look closely, the D4 we already calculated here, which is 4.98 from step number 1. Okay, D4 is 4.98. So we just put it here, 4.98. Okay, so the K, the rate of return, is from the question. K is 15%. Okay, 0.15. And the G. Okay, so this is the tricky part, not that tricky. You need to remember this rule. We have multiple G's. Okay, we have 5%, 15, 25, and lastly 10%. So we have a lot of G's to be used. Okay, for our model, okay, we are going to use the last one. Okay, the last G. Okay, not the first, not the second, the last one. Okay, so in our case here, the last G is 10%. Here, 10%. Then we can calculate to get the value or the selling price. So we have here 99 ringgit and 60 cents. Okay, so that's our selling price. So there you have it. We have all the dividends. We have the selling price. So therefore, we can find the intrinsic value by discounting all the relevant information. Okay, so for step 3, the last step, what you need to do is to discount the relevant dividends and selling price. Okay, so we need to discount all the relevant dividends and also the selling price. So we're going to use the same formula as our constant and inconstant dividends, which is based on this VI equals to, this one, if we go back to here. Okay, so we're going to use something like this, formula of this. Okay, D1 divided by 1 plus K plus D2 divided by 1 plus K squared plus until the last N, which is the N, divided by 1 plus K to the power of N. Then we have the selling price, okay, divided by 1 plus K to the power of N. Okay, and note the N of selling price, which is V, and also the final of dividend must be consistent. So if we have until dividend until 4, the V must be 4 as well. Okay, if it's 3, 3 lah. Right, so the final dividends and the selling price here must be the same. Okay, the final N must be the same. Okay, so let's go back to the question just now. So we're going to start with D1. We always start with D1. We will not start with D0. We're going to start with D1. So from the step number 1 tadi, even though we have D0, we're not going to use D0 as part of our formula, because our formula for dividend discount model always the following year's dividend, D1. Okay, so D1 is RM3.15. Okay, dividend RM3.15. and divide by 1 plus k. The k is 15%, so therefore it's 1.15, 1 plus k, plus second year's dividend is 3.62 ringgit. Okay, divide by 1 plus k to the power of 2 squared, because this is the second year. Then the third year, it's 4.53 cents. That'd be 1.15 to the power of 3. Okay, so this is the not the tricky lah, but just to explain to you why we're gonna stop until D3. Okay, if you look at step number 2, the selling price or the V is based on year number 3. Okay, we're gonna use V3. So if this is V3, so remember our V last is 3, kan? So automatically our last dividend would be dividend number 3 as well. So even though we have dividend 4 here, we're not going to use it in our step number 3. Okay, so we're going to use the first 3 years of dividend only, because technically that's our matching end here. Okay, the end is based on year number 3. Okay, we cannot use dividend 1 plus dividend 2 plus dividend 3 plus dividend 4, and then the value or the price based on year 3. Okay, so it's not correct. Okay, so therefore, the last part will be taking the selling price, which is 99.60 divided by 1.15, still to the power of 3, because this is based on the third year. Okay, so to simplify, right, I always encourage to underline D0 with D1, if any. If you start with D1, you don't have to underline. Another line would be this part. One line before the final G change. Because this part, okay, we're going to use in step, sorry. Okay, we're going to use in step 3, this information. Okay, this one, we're going to use in step 2 only, which is this part. Okay, for 98, we just use in step 2, one time. We're not going to repeat it in step number 3 again. Okay, and finally, this 99.60 will be used in step 3 as well as a selling price. Okay, so this is our information that we use. So once you have this, calculate and get me the answer. Can someone calculate that? Okay, 315 plus 362 plus 453, then plus 99.60. Okay, all of this divide by 1.15 S1 plus K. Can you share your answer here? Okay, ada yang 7381, ada yang 7394. Anything else? Right. 562, 2, 4.53, 6. Okay, based on my own calculation, based on this information that I use, answer is 73 ringgit and 94 cents. Okay, 73 ringgit and 94 cents. Okay, so that would be the intrinsic value. Okay, the intrinsic value based on example number 4. And again, if the question asks us to comment or to compare or to make decisions whether to buy or not the share, we need to compare this against the market price, whether it's under or overvalued. Okay, the same approach as before. Okay, but for this question, they don't ask us to compare, right? So we stop until here. But the question might ask you to compare or to decide whether to buy or not. So what you need to do is to compare this intrinsic value against the market price and to see whether the market price is higher or lower than the intrinsic value. Okay, if it's higher, if market price is higher than intrinsic value, then it's overvalued. And if it's lower, then it's undervalued. Okay, and remember, undervalued, we're going to buy. Overvalued, we will not buy it because it's expensive. Okay. So that's based on our first technique. We are still in quantitative aspects of company analysis. And under this analysis, we have the first part, which is the dividend discount model. Okay, discount model. Okay, maybe we can try one simple example here from the exercise. We discussed pretty much most of it. Okay, if you see the videos, one video. Anyway, so here, can you try question number 5? Because this is actually an example of a non-constant growth model. Okay, for example, here the growth rate of 8% for the first 3 years, then 10% for the until the 6th year, and then 6% okay, growth perpetuity. So we have 8, 10, 6. So we have 3 different growth rates. Then they give you 20 cents as dividend. And this is, again, they use the word last dividend. So it means this is our D0, our current dividend. Okay. Just to let you know, kalau you tak clear last week, they might use something like this. Okay, expected to pay a dividend. So this is next year lagi. So this is your D1. Right, so just read the question carefully to identify whether it's D0 or D1 as your starting point. As your starting point, the question might give you either D0 or D1. Okay, so for this case, it's still D0. So you're going to do the same process as what I did earlier. And then the K, the required rate of return is 10%. Okay, find the intrinsic value. Okay, so can you try this within, I don't know, 5 minutes? Nanti kita discuss what will be the answer. So anybody? Five, 3, 6. Okay. Any other answer? Let's look. Well, let's try it together lah, yeah. Because I also can't remember the actual answer. I think slightly higher than 536. Okay, step one. Gonna find the dividends first. So the question gave us D0, which is 20 cents. Okay, so you're gonna find until the last G. So the final G, the 6%, happen in year 7 onwards, because until year 6 it will be 10%, and then 6% will be 7 onwards. So meaning we need to find until D7, dividend number 7. So 20 cents increased by 8%. Okay, we have 22 cents. D2, another 8%. Cents. Okay, and the final 8% in year 3. 5. Maybe 4. Okay, will increase to 10%. Okay, 10% for another 3 years. So 1.1 to 8. B5. 0.30. is 6. Is our final 10%. 4. And lastly, D7 would increase at 6% till perpetuity. So that 0.36. Okay. So by the way, even though I wrote every two decimals, but in my calculators, boleh je 2 or 4. But for me, from my calculators, I just keep every decimals first based on every calculation, every level ni. I wrote 2, but in my calculators, I just keep everything. I tak adalah recalculate from 0.22 times 1.08. I'm gonna use the whole numbers from my calculators. Okay, for the sake of writing, I put 2 decimals. But if you want to put 4 decimals, it's okay actually. Okay, obviously the more decimals you put, the closer your answer and ataupun the more accurate your answer. Okay, but I just wrote here 2 decimal because this is money. Money is ringgit and cents, kan? So our decimals selalunya cents only 2 decimals. Okay, that's the reason why I put 2 decimals lah. Okay, so but it's up to you lah. Kalau nak letak 4, still acceptable lah. Now step 2. Okay, we need to find the price before. So since our dividend is until year 7, so our price before year 6 lah. Year 6. So it's 36 cents here. And we take K minus G. Our K from the question was 10%. And our G is 6%. Okay, remember we're going to use the last one. Okay, we're going to use the final G, 6%. So I have here 8 ringgit and 89 cents. Okay, so once you have this, then we can discount step 3. Going to discount the relevant dividends and the selling price. So remember we have the selling price in year 6. So we're going to use only 6 years of dividend. Okay, from 22 cents ni up until 34 cents. So the intrinsic value would be 22 cents. 22 cents divided by 1 plus K. The K is 10%. So divided by 1.1 plus 2, 3. Of 2 plus 0.25 1 to the power of 3 plus 0.28 to the power of 4. Okay, add lagi kat sini. 30 cents 1 to the power of 5 plus 34 cents 1 to the power of 6. And lastly, our selling price, 8 ringgit and 89 cents 1.1 to the power of 6. So here I get about PFM RM6.17. 6 ringgit and 17 cents. So that is the answer for question number 5. This line. So we have 7 years of dividends, but we're going to use the 36 cents for our step number 2 only. Then for step number 3, we're going to discount 6 years of dividends. And if you have 6 years of dividend, so our selling price must be in the year 6 as well. Okay, remember our final ni mesti consistent. It bukan 6 lepas tu ni 7, no. Must be 6 and 6. Last dividend and selling price must have a consistent end, which is the year. Okay, so this is question number 5. Right, so roughly, if you look back on the videos, I discussed pretty much most of the questions. Perhaps one more question I discuss, which is question number 8. Okay, me quickly lah kita go through. So question number 8, Babyface Corporation has just paid a dividend. So again, they use the word just paid of 180. So this is our D0. The company's current stock price is 18 ringgit. So this is current price. Dividend are expected to grow at a constant rate. So when they say constant rate, it means from our third model. Okay, remember our model yang tadi saya tunjuk tu, P1K minus G tu, with the G rate of 8%, and the K is 15%. Okay, what will be the stock price? Okay, this is the question that you need to be careful. But the question asks you to find the stock price, but not the stock price now, not the intrinsic value, but the stock price 4 years from now. Okay, 4 years from now. So if you recall, okay, my formula, this one tadi. My formula, if you want to find the value, okay, regardless of what year, we're going to use this formula. Okay, kita akan gunakan formula ni as a basis for any questions related to constant growth. Okay, regardless of which year. So kalau dia cari intrinsic value, we're going to put V0 kan. V0 is D1. 0 plus 1 is D1. Okay, but for the question just now, it asks us to find the price during the 4th year. So technically, the question asks us to find V4. And again, if you remember, if it's V4, we're going to use D5. Okay, Dn plus 1. So n plus 1 is 4 plus 1, which is D5. And then K minus G. So K and G is very straightforward. The K is 15%, the G is 8%. So what you need to do is to find D5. So we have here from the question, we start with D0. Okay, so to find D5, there are 2 ways to find it. You can use like our first step in the inconstant model, whereby you're going to start with D0, 1.8, and then D1. You can find 1.8 times with the growth rate of 8%. So you multiply with 1.08, and then you find the number, and then bring forward, and then calculate until D5. Okay, but since this is a constant growth rate, okay, we can simplify the steps because the rates will be the same. Okay, kalau non-constant tadi, they change. After a few years, they change. Okay? So we have to do that way, right? But for the constant growth model, to find D5, we can simplify by using the power. Okay, the power, what does it mean by power? It means, since this is D0, so our D0 is 180, and we want to find D5, so what we need to do is to power the growth by that number of year. So meaning is if our growth rate is 8%, 1.08. So we're going to power this 1.08 with 5. Okay, then we're going to find D5 straight away. Okay, and this way, ataupun this method can be used only if it's constant. Okay, constant. So meaning, for example, bear with me 1 second. Okay, like this one just now. This one cannot lah. Example tadi just we calculate this one tadi. Okay, tak save. The example just now. This one. Oh yeah, this one. Okay, sorry. So for the first 3 years, okay, if you don't want to calculate one by one like this, you can actually find for the first 3 years, 0.2, 1.08 to the power of 3. So you should get around this answer, 0.25 something. Okay, but once they change to 10%, you cannot do power of 4 because the rate is different. Okay, so for the constant growth just now, since you're going to have the same rate, right, 8%, so we can find, or we can power with 5 to find the dividend for the 5th year. Just like that, and then K minus G. So the K is 50%, and the growth rate is 8%. So P 1.08, sorry, 1.08 to the power of 5. Okay, you dapat 1.469 something. Multiply with 1.8, 1.80 cents. Then that will be your dividend for 5th year, 2.64 cents. And divide with the difference of 15 and 8 is 7%. So divide by 7%. So the answer for this question number 8 is 37 ringgit and 78 cents. Okay, so this is the price 4 years from now. Okay, 4 years from now. Okay, so be careful on the requirement of the question. It's not necessarily they ask you to find the intrinsic value, which is BI or V0. They can ask you some values in the future. Like for this, they ask you to find the price 4 years from now. Okay, 4 years from now. So current price 18 ringgit. So meaning 4 years from now, it will be worth 37 ringgit and 78 cents. That would be the assumption. Okay, so that's our end line untuk the dividend discount model. So we go back to here, bear with me. Okay, so basically this is done. Okay, present value dividend, whereby we have 4 models. I recap, we have constant dividend, we have inconstant dividend, we have constant growth, the third model. And lastly, tadi inconstant growth. Okay, so these are the 4 models, falls under the method or the techniques of present value of dividends, or DDM. Okay, so this is done. So next we're going to discuss about relative valuation techniques, which we use the PE ratio or the earnings multiplier techniques. Okay, and again, the one yang kat bawah ni we're not going to discuss lah. Just discuss 2 parts here. Ni pun dah ambil 2 weeks nak discuss kan. So next we're going to look at the relative valuation techniques, and still we're going to find the intrinsic value. Okay, we're going to still find intrinsic value. Okay, so for the relative valuation techniques, we're going to focus on the PE ratio, which is price to earnings ratio model. So basically, when we talk about PE ratio, the ones that comes to mind is supposed to be the price, okay, market price, with the earning per share ratio, which is this part. Okay, but we're gonna use this concept. Okay, we're gonna use this concept actually to find what we call as intrinsic value, which is the price of the stock today. And the intrinsic value here is based on this market price per share. So in order to find what we call as intrinsic value, we're gonna replicate this formula, okay, which is to use the PE ratio. Okay, so if we want to find IV, which is the market price, what we need to do, we need to multiply the PE ratio versus the earning per share. Okay, so this is our basis later on to find the intrinsic value based on relative techniques. To find the intrinsic value, we need to use the PE ratio and we multiply with earning per share. And if you cannot remember, or if you didn't remember the earning per share is basically net income or net profits. It's the same thing, net profit or net income. We divide with the shares outstanding. Okay, In short, usually we use the terms NOSO, number of shares outstanding. Okay, so then we get the EPS, and obviously to get the intrinsic value, we multiply with the PE ratio. But in order to find the intrinsic value, it's not as easy or it's not as direct as just multiply the two elements, because some of the questions might ask you to find your own net profit, okay, and then maybe you need to find your own PE ratio. Okay, it's not as simple as, okay, the PE ratio of company A is so and so, and the EPS is this. Find the intrinsic value. It's not that simple lah. It's not that straightforward. In order to you utilize this formula, you need to find sometimes the internal parts of the PE and also EPS. Okay, so therefore we're gonna do one exercise later on to dissect and also to discuss how to go about to find the PE and also earning per share. Right, because under the PE ratio, okay, the formula that we're gonna use for PE later on is dividend payout ratio. Okay, dividend payout ratio with K minus G. Okay, and if you see closely, this is pretty much similar with our constant growth model from our previous method. Within this model, we have constant growth, kan? So the price, or the PE in this case, will be based on dividend payout, okay, which is dividend payout ratio, and also K minus G, which is the rate of return, required rate of return minus G. And again, for the relative techniques, sometimes the G also might not be given directly. Okay, for our model before, the growth rate will be given. Okay, but for these relative techniques, the question might not give you the G, the growth rate. Therefore, we need to find ourselves the G. So this one, we need to find ourselves, dividend payout ratio, and we need to find the G as well. So how to find these two? Okay, this one, the formula I just mentioned tadi. Okay, the dividend. So to find the dividend payout ratio, okay, D1, this is the formula that we need to use. Okay, which is dividend. We divide with earnings. Okay, or price pula lah. Sorry, net profit. Okay, but this is if based on individual, in total. Okay, total dividend paid with net profits. Or you can use the one which is dividend per share. Dividend per share. You divide with net profit, divide by NOSO, if you remember just now. Net profit divided by NOSO, which is earning per share. So we can divide with earning per share. Find this part, which is dividend payout ratio. So to find dividend payout ratio, you can use the value in total, or you can use the per share basis information. Both relates to dividends and net profit, which is earnings. Okay, so this is another parts, which is part of your PE ratio, which is this part. Okay, here we use dividend payout ratio lah. Okay, with K minus G. And as I said, sometimes they might ask us to find G, the growth rate. So the rest is the same as before. K is the required rate of return, and G is the expected growth. So I will not go into detail. I will not repeat again what is K and what is G. But I want to share with you how to find G, this one, if it's not given in the question. So for finding G, okay, the expected growth rates, it consists of two elements. Okay, first is the retention rates, which symbolized with the letter B. And next is ROE, return on equity. Okay, or ROE lah. So first, let's look at B, which is the retention rates. Okay, so to find B, this is the formula, I minus DPR, dividend payout ratio. Okay, so to find dividend payout ratio, I already mentioned just now, is based on this one. Dividend divided by MP, or dividend per share divided by earning per share. So to illustrate further, maybe I can share with you the basis of dividend payout ratio is from the net profits. Okay, from the net profit of the company. So the company, once they announce their profit, they will pay dividend. Okay, they will pay dividend. So they will pay dividend here, right? And so what happened to the rest of the money? Okay, so as a company, the rest of the money, they will reinvest back in the business in the form of retained earnings. Okay, so if you see this retention rate, this is technically the retention rate, or B tadi lah. Okay, this part, the retained earnings side. So that's why the formula is 1 minus dividend payout ratio. And if you recall the formula for dividend payout ratio, again, I recap, dividend payout ratio, it's dividend divided by net profit. So therefore, if let's say your net profit is 100 million ringgit, okay, and the company decides that the dividend would be, let's say, 30 million ringgit, 30 million ringgit, we know automatically the retained earning would be 70 million, because the balance from this transaction will be channeled to the retained earning, which is in this case 70 million. Okay, so to find it in percentage, if to find the dividend payout ratio means we divide dividend with net profit, so 30 million divided by 100 million. So you have a dividend payout ratio of 30%. And therefore, to find this part, the retention rate or B or even the retained earnings, so you take 1 minus dividend payout ratio. So 1 minus 30% is 70%. Okay, so this is our B actually, to find this 70%. Okay, by taking 1 minus dividend payout ratio. Okay, so that's how we find D. And for return on equity, okay, so to find return on equity, we're going to use this formula. Again, some of these ratios you've learned before. In fact, DPR, dividend payout ratio, you've learned before during financial management. ROE also the same. To find ROE, simply take net profit, net income, we divide with equity. Okay, so that's ROE. So this is alternative. Okay, you don't have to worry about this one. So as I said, we need to find EPS, we need to find PE. So basically to find step 3, sebenarnya ada satu lagi to step 3. Find IV. And how to find IV is basically IV equals to PE times EPS. This will be actually the third steps. Okay, find EPS, find PE, and lastly, find the intrinsic value. Okay, and PE just now, if you recall, it's PE equals to dividend payout ratio, K minus D. K for EPS, it's net profit divided by number of shares outstanding also. Okay, so let's try to look based on this example. Okay, generally this is the one that we need, but again, sometimes we need to find G ourselves. We need this the G formulas earlier, the retention rate times ROE. Yeah, that's about it. Okay, the rest will be quite straightforward. Right, so this example, the following companies have the current financial standing. The current sales is 500 million and expected to increase by 20% next year. So if 500 increased by 20%, we can get a 600 million. So this would be next year's sales, 600 million. Right? Net profit margin is 5%. If you recall, again, this is something you've learned before. When we talk about net profit margin is actually net profit divided by sales. So why they give us this information, net profit margin? We have sales values based on this. We have the net profit margin, which is 5%. So therefore, the usage of this is to find this net profits. because we have these values and we have these values. So the unknown value is net profit. So we're going to use net profit because a lot of our formulas, okay, rely on net profits. Okay, so we need to find this information to find EPS especially. Next, the NOSO, the number of shares outstanding, 50 million units. Okay, 50 million units is the number of shares outstanding, all right. And the one in G, okay, the growth rate, bear with me, the growth rate, we need the ROE, return on equity, which is this part, the equity part. So one of the items under equity is common shares, okay, ataupun shareholders equity. So the number of shares outstanding currently is 50 million units, and each unit worth 2 ringgit. Okay, shareholders equity per share, which is 1 unit basis, is 2 ringgit each. So therefore, to find the total equity, we need to multiply these 50 million units with 2 ringgit. So 50 million times 2 ringgit, a total of 100 million ringgits of total equity. So when we want to find return on equity later, total equity is 100 million. Okay, so that's some other information related to equity. And then we have K. K given 18%. And 45% is the DPS. This is dividend per share. So why we need dividend per share? Again, when we want to find DPOR, okay, dividend payout ratio, is DPS divided by EPS, okay, earning per share. Okay, let's try to solve the question. So the question asks us to estimate next year's information. So from A until I. Okay, A until I, right, which is the intrinsic value lah, the last one. So we need to go one by one. Okay, sales, I think I've already showed you earlier. Okay, the next year's sales is from 500 million original and increased by 20%. It's 600 million is the value of next year's sales. And as I said tadi, the net profit margin is 5%. So therefore, if net profit margin is net profit divided by sales, so therefore, if net profit margin is 5%, so what would be the net profit? If the sales is 6 million, so net profit equals to, so 600 times 5% is 30 million ringgit. So the net profit is 30 million ringgit. Okay, simply multiply lah, 600 multiply with 5%. Then we get net profit of 30 million. Okay, one of the most important information, the earning per share. To find earning per share, it's net profit divided by NOSO, number of shares outstanding. Okay, number of shares outstanding. Our net profit is 30 million. And our number of shares outstanding from the question was 50 million units. So we divide with 50 million units. So 30 million divided by 50 million, you're going to get 60 cents. So the earning per share is 60 cents. So for every 1 ringgit investment, our earnings is equivalent to 60 cents. So that's what it's meant by 60 cents here. For every share that we invest, 1 ringgit values, we're going to get 60 cents earnings or 60 cents net profits. Okay, so this is one of the information that we need, EPS. Next, the question asks for ROE. And if you remember, ROE is required to find the growth rates. And to find return on equity, the formula is net profit divided by total equity. And our net profit earlier, 30 million. And we already defined our total equity based on the number of shares outstanding and multiply with the 2 ringgit value per share, which total of 100 million. So we divide with 100 million. So 30 divided by 100 is 30%. Okay, return on equity is 30%. And dividend payout ratio. Okay, And if you remember, one of the formula is dividend per share divided by earning per share. Our DPS, dividend per share, you can get it from the question. Okay. Dividend per share is 45 cents. And our earning per share, 60 cents. So take 45 cents divided by 60 cents. So we have 0.75. Okay, so the dividend payout ratio is about 75%. Okay, 75%. Next, F, the retention rate, or B. And if you remember to find B, it's 1 minus DPR. 1 minus DPR ratio. Okay, 1 minus the DPR ratio. So technically it's 1 minus 0.75. Okay, which is 0.25 or 25%. You want to put it in percentage, it's 25%. Okay, yeah, 1 minus 75, which is 25%. Therefore, to find the growth rate, it's B multiplied with ROE. So our B is 25%. And our return on equity was 30%. So 25% times 30%, you have here 7.5%. This is the dividend growth rate, the G. So now we have the G, the K is given in the question. We have the DPOR as well. Okay, the next will be, what will be the PE ratio? So PE ratio, if you remember, I wrote here, find the PE ratio is dividend payout ratio divided by K minus G. Okay, so PE, it's dividend payout ratio divided by K minus G. Dividend payout ratio, 75 cents or 0.75. K from the question is 18%. The investor's required rate of return is 18%. The K. And the G just now, 7.5%. So it's 0.075. So take your calculator, divide by 8 minus 0.075. So we have here 7 ringgit and 14 cents. So this is our PE ratio, price to earnings. And finally, to find the intrinsic value, it's PE multiply with earning per share. So our PE 7.14 and the earning per share 60 cents. So 6, so we have here 4.29. So the intrinsic value is 4.29 cents. So this is the process to find the intrinsic value based on the relative techniques. Slightly lengthy, but still revolve around the constant growth model, which is this part. This is actually constant growth. But the way we find the growth rates, okay, we need to find ourselves most of the time, okay, which relies on this formula, the retention rates multiplied with the ROE. Okay, slightly lengthy. Okay, so it depends on the questions. Okay, it depends on the questions, depending how much information given. Like this one, most of the information you need to find yourself. Okay, and if you notice, this is all based on ratios. You've learned ratios in FM before, financial management. Some of the ratios, like this one, net profit margin, the EPS, the ROE, even the DPOR, everything here you've learned in financial management before. Okay, in the financial ratios. Okay, so it's not a new thing. It is just a recap, and we revisit back the usage of ratios to solve the relative techniques method. Okay, so with that, I think that's the end. You can try a lot of other examples here. You can try to answer to find the information. But anyway, so that's the final part of topic 5. Okay, which is related to company analysis. So as a recap for topic 4 and 5, what we've learned for the past 2 weeks or 1.5 weeks, we've learned in topic number 4, when we do company analysis, not company analysis, meaning when we want to do analysis related to what we call investment analysis. We have two parts. We have two techniques, which is called top-down approach and bottom-up approach. Top-down approach starts with economic analysis, whereby we study the economy of the country. We're going to look at the GDP. We can look at the unemployment rates, the inflation rates, and whatnot for countries' evaluation. Next, second level of the country, the next one, the middle one, is from the industry analysis. We can study about the industry's performance. Okay, can be affected by the economy or not, for example. And lastly, the third level would be based on company analysis, and that's what we learned in topic number 5, actually, company analysis. So from top down, we have step-by-step approach. But from bottom-up approach, the other one, we're going to go straight to the company analysis. Okay, they will disregard the economic and also the industry analysis. Okay, and that's what we've learned in topic number 5. Okay, so next, okay, I'm going to discuss straight away. I'm not habiskan topic number 6 now. Okay, which is about equity portfolio management strategies. Okay, we've learned how to analyze, we learned how to evaluate. Okay, but here we're going to see there are two approaches of how to manage the portfolios. Okay, related to equity. Again, when you see the word equity here, basically refers to stocks or shares. How to manage our portfolio of shares. So how to choose. We have a certain amount of money now. Let's say you have, I don't know, 100,000 ringgit. How to choose your strategies, but how to choose your stocks. So there are two approaches here. Okay, the approach is very simple. Are we going to use active approach, or we're going to use a passive approach? Only two ways how to do this. The one that we discussed thoroughly, okay, rigorously before, basically using the active approach, meaning we need to do our own analysis in order to decide which stocks will be part of our portfolio. But alternatively, we're going to have another school of thought which relies on the passive approach. So passive, instead of doing a lot of analysis, what we need to do is just to copy. So what kind of copy? Okay, that's what we're going to discuss next, which is based on the passive approach. Okay, so it's passive versus active. Okay, and as I said, active mostly relates with the actual analysis, actual evaluation of stocks, and then we're going to decide whether the stocks will be undervalued or not. And then we will choose which stocks is suitable in our portfolio. Okay, versus our risk factor as well, because everyone have a risk element, right? Whether you want to take high risk or not. So I'm gonna go straight to passive first. Okay, so passive strategy is going to replicate. Okay, what we're going to do is try to replicate or try to copy the performance of an index. Okay, what kind of index? In any country, there will be major index ataupun usually they have multiple indices lah. right? And here, as you can see, in US, they have these two major indices, S&P 500 index and Nasdaq Composite Index. So S&P 500 index basically is a index. Index is a list of shares. Okay, when they say S&P 500, it means in that particular index, they have 500 companies inside there, 500 shares or 500 stocks of companies to generate the index. Index is basically the movement of prices for a basket of stocks. Okay, but from Malaysian point of view, okay, the index in Malaysia issued or generated by two companies. Okay, two companies. We have the first one known as FTSE. Okay, FTSE ni kita panggil dia FTSE don't say FTSE Look too amateurs kalau you said FTSE is FTSE. See in short see. Okay, so this is based from the UK. Right, and then in the Malaysian counterpart, we have Bursa Malaysia. Bursa Malaysia. Okay, and when they combine, it's called Fbm, FTSE Bursa Malaysia. And under Fbm, they have a lot of indices. And the main one, okay, which is known as Kuala Lumpur Composite Index. Okay, similar like these are, but this is Nasdaq Composite Index. But here in Malaysia, we have Kuala Lumpur Composite Index. Okay, so that's why I'm going to show you here what is indices. Okay, indices is the plural. Indices ni plural of index. Index to singular. When we have multiple of index, we call them indices. Okay, so in Malaysia, the index or the indices is joined by these two lah. Like I said tadi, Bursa Malaysia and FTSE Group since 2006. So in Malaysia, we have the main market and the ACE market. So here, as you can see, the main indicator is the FTSE Bursa Malaysia, which is Fbm KLCI. And under Fbm KLCI, we have top 30 companies in the country, okay, to make up this index, the top 30 companies in the country. And the second index, we have FTSE Bursa Malaysia, which is Fbm Mid 70 index. Okay, here consists of middle 70. So meaning after top 30, then we have the mid 70. Okay, so from number 31 until number 70 lah, basically. Right? And when they combine the top 30 and mid 70, then we have the third model or the third index, which is Fbm, FTSE Bursa Malaysia, top 100 index. Okay. And if you want to see the companies under the Fbm KLCIs, you can look under the index constituents. So the constituents will indicate what are the companies. So for example, here, the top 30 companies in the country based on the Fbm KLCI. Is this company. So as you can see here, we have Axiata, CIMB Group, Dialog Group, DG, Genting. Right, it's broad lah. It comes some from Axiata ni, Telco. We have the banking groups. We have property development companies, Hapsang, Hasalega. We have healthcare companies, Healthcare also, property developer, MIC shipping companies, Nestle consumer products, Petronas oil and gas companies. So it's a broad companies, right? Telecom and also Tenaga, which is part of also government-linked companies. Okay, so these are the 30 companies. So what's the relationship with the passive just now? So when we said passive, instead of we do analysis to choose which company to set up our portfolios, what we need to do, we just use this index as our reference, and we're going to select these companies, right? We don't do any analysis for it. So in preparing our portfolios passively, we just choose this company, right? So that's what is meant by passive managed funds. We don't do a lot of analysis. We just copy. We just copy, right? So that's why the passive equity portfolio strategies is try to replicate the performance of index by copying the index. However, there's the pros and cons kat sini lah, right? One, in terms of the index itself, the index will move ups and downs depending on the performance of the 30 companies, right? So if the performance going up, then it's okay. But sometimes the index will going down as well for a long run. So therefore, if you use the index, automatically your selection of portfolios will going down together with the index. So dia akan go directly ataupun go positively with the index, going up or going down. And another thing, imagine you have 30 companies just now. Okay, 30 companies. And to invest in 30 companies, you have to pay a lot of fees and commissions. Okay, because the transactions relates with the fees. Okay, even though if you compare the management fees, we have two types of fees here. We have the manager's fees. If we decides to give our funds to our managers, the managers from passive strategies will charge slightly lower as compared to active, because active will do a lot of analysis and will utilize their knowledge and experience to choose for you which companies. For passive strategies, they will charge you less. Okay, they charge you less, but if you use their strategies, the cost for the fees and commissions to the agents or to the banks might be expensive because you need to invest in a lot more stocks. Because if you do, especially if you do full replication, because under the passive equity portfolio strategies, we have three different strategies, which is this part. Okay, we have full replication, we have sampling, and we have quality optimizations. So what would be the difference between the three? So the word full replication indicates we're going to copy 100% from the index. Okay, so imagine just now if we have FBM KLCI. So what you need to do, you need to buy 30 companies or 30 shares. 30 shares of companies. So imagine you have to pay 30 different fees and commissions to the banks when you want to purchase. So that's the downside of full replication, the cost. But again, if the index is going up, your stocks values will going up together with the index. Okay, without doing any analysis, but you just copy it. Okay, but if you don't do full replication, we can do number two, sampling. Okay, sampling meaning you buy a representative sample of the stocks. So again, from 30 companies, okay, you're gonna sample maybe, I don't know, 10 companies or 5 companies out of these 30 companies. Okay, so this is what is meant by sampling. So therefore, if we do sampling, we don't have to buy 30. So therefore, we need to pay a lower commissions. So our costs and commissions will be cheaper. Okay, however, the performance of your index reference here will not be the same as full replication, because full replication you guna semua, all 30 companies. But here you do sampling, right? So if you choose wrong companies, 5 or even 10 out of 30, obviously you will not be as close as the index. So meaning there's a possibility that the performance is not according to the index. So kalau maksudnya kat sini, maybe the index going up, tapi your sampling tu is going down because of the selection of the companies, not according to the 30 companies. Okay, give me 1 second boleh tak? Sekejap je. Okay, so that's sampling. And the third one would be quadratic optimization. Okay, quadratic optimization. Again, we're going to rely on historical data of the companies from the index. But here we're going to rely on computer programming. Okay, by using computer programming, we're going to determine which stocks out of 30, for example, that will be part of our portfolio. Okay, and this will obviously minimize the tracking error from the benchmark. So meaning, instead of doing all 30, we will still use sampling. However, we're going to use some computer programming to decide which are considered as the best stocks as part of your portfolio. Okay, so out of 3, okay, obviously full replication will be the most expensive, right? And if you have the technology, we can use quadratic to choose the top maybe 5 companies that will try to mimic exactly as a full replication. So this is passive, right? Example of passive, right? And besides the index fund that we can use to invest, but remember when we talk about index just now, this part, like this Fbm KLCI with 30 companies. Okay, this index, we cannot invest directly in index, okay, because indexing is just indicators, okay, because it's what we call, they generate based on the performance of these 30 companies, but we cannot invest in index. Okay, to passively manage funds, we cannot invest in index. However, okay, we have another elements or another types of investment which can again mimic, right, ataupun replicate the index punya performance. Okay, still part of passive managed funds based on equity. If you remember, equity to shares kan. Okay, we can invest in shares whereby we buy all 30 shares just now, for example. Alternatively, we can invest in what we call as Etfs. Okay, exchange traded funds. Okay, so exchange traded funds is a fund. Okay, imagine like a unit trust. You invest in a unit trust. The unit trust will invest in a diversified portfolios. So for ETFs, it's similar like that. Okay, ETF will provide a fund whereby these funds will invest on the underlying basket of shares. Okay, so for example, if we refer to equity ETFs, meaning this ETF will invest in equity sahaja, meaning all in shares. And under equity ETFs, we have, for example, under equity, the Fbm KLCI. Remember, we have under Fbm KLCI, we have 30 companies, right? And by having this equity ETF of Fbm KLCI, these particular funds will invest in the 30 companies. Okay, the 30 companies that they have under the Bursa Malaysia. For example, here, they will give investors exposure to 30 biggest listed companies in the country, which is the Fbm KLCI. So we cannot invest directly in the index, but we can invest in ETF instead. So why? Because ETF, you invest, they're similar like shares, they can go into bought lot, whereby one lot equivalent to 100 units. So just like you invest in shares, you invest in the fund. Okay, here are the fund manager. And then what you need to do, basically, you invest just like you purchase shares. And that share represent basically 30 companies in one investment. Okay, and this is another element of passive. You don't do analysis of company whether they, undervalue ke overvalue ke. You just invest according to the index. Okay, so this is another passive way to invest without do any analysis based off Fbm KLCI ETF. Okay, so that's index fund number 1 tadi, and then we have exchange traded funds. Okay, kalau kat Malaysia tadi we have Fbm KLCI ETF, exchange traded fund. Okay, so that's why I said is It's quite similar like unit trust, mutual funds, but the exposure is more on the, kalau equity they will invest in share markets. Okay, next is the active one. Okay, as I said, as compared to passive, which just copy from index, active portfolio strategies requires us to do a lot of analysis in order to choose which stocks will be part of our portfolio. Right, so the one that we discussed again since topic 4, topic 5, that is actually part of our active equity portfolio strategies. Right, the difference between active and passive, besides the more active or hands-on approach of the selections, is in terms of the cost. Okay, cost for the managers. Like I said, active portfolio managers is more expensive as compared to passive. Okay, because active they have to do more work. Okay, they have to do a lot more analysis. However, if you compare passive tadi, if you do full replication, you have to purchase 30 shares. Imagine you have to purchase 30 shares, but for active, they will choose you the best 5, regardless they are the top 30 or not. Okay, because even though top 30 in the country, sometimes the top 30 companies might have overvalued in terms of their current positions. Okay, so if we use active portfolio strategies, those companies might not be part of our portfolios because they are overvalued. All right, so we are looking, more on the experience and also knowledge of the managers in order to make decision for us, and that's why they charge slightly higher as compared to the passive managers. Okay, so as a summary, passive, as I said tadi, they use more on the index and also ETFs. But for active management strategies, they focus on the fundamental analysis, which is based on the top-down and bottom-up approach. We've learned this in topic 4 and 5. A lot of financial analysis, okay, all the ratios, all the calculations part. Or alternatively, for active managers, they can use technical analysis. Okay, we didn't learn about technical analysis, but I don't know you've learned this before in investment planning or not. Okay, because it's not part of our syllabus anyway for this course for technical analysis. Some other universities learn technical analysis for 1 semester, for 1 course, whereby this technical analysis is about trend. Here we study about trend analysis of the stocks. And how to study trend? By looking at the graphs. Going to study the graphs and then plot using items or using charting tools like candlestick tools, right? A lot of tools that can be used lah. Okay, bar chart or whatever to study the trend. Okay, and also usually when they study trend, they will look in the price. Okay, so these are the active management strategies. So to conclude, okay, you can read the rest ni nanti. To conclude the difference between active and passive, let me share with you one video.
Your money at work. Insights that can help you build a more secure future. Brought to you by PIMCO. People invest for many reasons. No matter what your personal financial goals may be, to reach them, you need to make sure your money is working hard and working smart. But with today's complex global markets and so many investment choices available, it can be hard to decide what's right for you. Understanding a few basic concepts can help you make more informed decisions about investing. This video will help you get started. Active versus passive investing. There are a number of variables to consider when choosing investments. One important decision is the choice between active and passive management. Passively managed funds are often called index funds because they are usually tied to an established index that represents a particular market. For example, the S&P 500 index consists of 500 large U.S. company stocks and is commonly considered a proxy for the U.S. stock market. You cannot invest directly in an index, but passively managed index funds are designed to closely track the performance of a particular index by investing in all or a representative portion of the securities in the index. The performance of actively managed funds, on the other hand, depends heavily on the skills and experience of its manager and research analysts, as well as the investment strategies that are employed. Actively managed funds give the manager varying degrees of control over where and how to invest relative to the index. Depending on the manager's success, they may provide more or less return than a relevant index. Investors may be drawn to passively managed funds because they generally charge lower fees and provide investors with diversified exposure to key markets. But there are other criteria you may want to consider. Some investors are willing to pay more for the skill and experience of an active manager and the potential for better returns. Let's look more closely at each option. Passively managed funds are designed to track the performance of an index. That's a good thing in a strong market when prices are rising, but not so good in a falling market when investors may be exposed to a sudden or prolonged decline. There may also be concerns over how a fund is constructed. For example, the Barclays Aggregate Bond Index, which is a proxy for the US bond market, contains about 8,200 bonds. It's not possible for most funds to contain that many securities, so a passive manager must choose which securities to include and which to exclude. The method of selection may impact how closely a passively managed fund tracks an index. Investors may choose actively managed funds because of their potential to deliver better than index returns. Active managers have the flexibility to adapt a fund's holdings to a changing market environment. Using research and analysis, they can look for opportunities to enhance return potential, and when conditions are challenging, they can also try to manage risk. Keep in mind that the market may not always behave as the manager expects, and the fund may underperform as a result. That's why if you decide to put your money to work with an active manager.
Okay, so that's the conclusion, the comparison between the active and also the passive strategies. Okay, they just recap whatever I said earlier. So I think that's about it for topic number 6. You can further read the difference between the two at the end. So moving forward, we are technically finished discussing about equities, okay, from topic 4, 5, and 6, all related to equities. Okay, so for topic number 7, we're going to discuss about bond. Okay, so we're going to discuss the bond valuations. Some of the bond valuation you already learned before, either in FM or even investment analysis. We're going to rediscuss a section about the valuation, but we have another new thing that I believe you haven't learned anything about that yet, which is about the duration. We have the Macaulay duration and modified duration. So we're going to discuss about that in topic number 7, and again later on in topic number 8. They have another portfolio management strategies, but now it's for the bond portfolio management strategies. Earlier, now topic 6 is equity, right? For topic number 8, it's about bond portfolio management strategies. Typically, it's quite similar. They still have the active versus passive as well, but in terms of the details might be slightly different from one to another. Okay, so that one we're gonna discuss later. Right. So yeah, that's about it for today. End of topic 6. So yeah, about halfway through. So next, I've discussed with the other groups about the midterm test. Okay, about the midterm test. I asked them about the dates as well. So I just throw the ideas of the dates until you let me know whether you guys okay or not with the dates, because I'm planning to do everyone punya test on the same day, because I have 3 groups, A, B, and C, right? So my plan was I have 3 dates. Okay, I have 3 dates. The first date too, if you guys agree with that date, you guys gonna move that particular date. But you guys dah ada dah for apa? Another paper, the test for that date. Okay, but that lecturer allow me to use that date kalau I nak, and she will move to the other dates. First on the 24th. Okay, 24th, which is next week, next Saturday. Kalau bukan 24th of April, on Saturday, I plan to do on Friday, 30th. Okay, Friday 30th. Or if not, then I'm going to do on the 1st. I know you have another test code on the 1st though. Okay, but kalau first tu, the test that you have in the morning, if I'm not mistaken, then I'm going to do at the afternoon session. So you can discuss. Okay, we have the group, nanti you let me know lah. Either 24th, you want to do on the 24th. 30th. Okay, 30th ni pun aku tak sure. Pagi ada kelas kot. Maybe we do afternoon session as well. And the 1st, which is on the Saturday. So kalau 24th ni, the original session you have, kalau tak 24 ni, kalau tak salah, you have zakat kot, zakat and tax kan. So if we choose 24th, then the zakat and tax we move to other dates. Okay, and then either that 30th or 1st. Okay, so nanti check lah. Okay, check with not check lah, just discuss among yourself and then let me know dalam group. Or else I akan decide sendiri nanti. Okay, most likely sebab I have 3 groups, nak cari weekdays punya time is quite difficult lah. So I prefer kalau weekend on Saturday lah. So we have 2 Saturdays, 24th or the 1st. Okay, or else kalau you guys free, then you can go on the 30th. Right, so I think that's about it for today. Nanti let me know the outcome of your discussion. And I will let you know juga the topics that will be part of the midterm test. And by the way, next week, we're going to discuss on the group project, which is the assignments, because we already discussed the equity management strategies. So that's basically can be used in your selections of portfolios for your group projects ataupun group assignment. Okay, so we're going to discuss next week in terms of the instructions, in terms of the rules and regulations, and also in terms of the the registration of the game. So just be prepared with the team. If I'm mistaken, I already let you know the team should be 3 members per group. Okay, I can try to find the group members now, and we will discuss in details next week. So with that, thank you very much. For those who observe, selamat buka, and the rest, I'll see you guys next week.
Thank you, Dr.
Thank you, Doctor.
Thank you, Doctor.
All right.